The balance on your banking app isn't what it seems. That statement isn't a metaphor, and it isn't late-night conspiracy talk. If every depositor tried to take out cash on the same day, the structure would buckle within hours, because most of that money is not stored in bills and coins anywhere. That wouldn't be a bug. It's the plan working. The design is old, deeply embedded, and so familiar that we accept it as normal reality. It's called fractional banking, the quiet engine behind global credit, inflation, and the illusion of easy wealth. Once you see the wiring, you realize money rests on promises that can never all be honored at once. By the way, if you love money, subscribe to the channel and give it a like. Now, let's continue. To see the origin, rewind to a world before cards, apps, and instant transfers. In medieval Europe, money meant metal, gold and silver coins stamped by rulers, or bars and jewels that could settle trade. Wealthy families and big merchants held chests of specie, and when they needed to travel, they faced a problem. Carrying treasure invited theft. Goldsmiths offered a solution. They already guarded vaults for their craft, so people left their metal with them. In exchange, the goldsmith issued a receipt, a bearer note that promised whoever held it could claim the gold. Those notes began to circulate because they were lighter than coins, yet stood for the same value. That is where the trick appeared. Goldsmiths noticed that redeemers arrived in a staggered trickle. Out of 100 clients, only a few would show up in any given week. The rest of the coins slumbered in the vault, doing nothing. The temptation was obvious. If 1,000 gold coins sat in storage and only a small fraction would be claimed at once, the goldsmith could issue more notes than there was metal to cover, then lend those extra notes at interest. Paper claims multiplied beyond the physical gold, and profits multiplied too. As long as everyone didn't show up together, nobody noticed. Value had been conjured out of signatures and confidence. Banks professionalized this habit and scaled it. By the 17th century, governments embraced the mechanism because it solved their hardest problem, paying for wars and state projects without finding piles of new treasure. The Bank of England was founded in 1694, not as a charity for shopkeepers, but as a funding machine for the crown. It extended credit far beyond its reserve of coin, and the government pledged future tax revenue to service the debt. Sound familiar? It should. The modern state still borrows sums typed into existence by banks and commits tomorrow's taxpayers to pay the interest. The United States traced a similar arc. Early American banks issued notes redeemable for gold or silver. They soon discovered the profit in over-issuing claims. Periodic panics exposed the illusion. Depositors rushed to the counter and found that the vaults didn't hold enough coin to satisfy them all. Entire institutions collapsed in a single afternoon. Instead of abolishing the model, lawmakers doubled down. They created central banks to act as lenders of last resort, the illusion's safety net, so that even when the cash wasn't there, public belief could be maintained. Fast forward to the present and translate the old habit into modern plumbing. You deposit $100 and imagine a neat pile tagged with your name. In reality, the bank keeps only a sliver as reserves or liquidity and transforms the rest into loans or securities. In the classic textbook picture, that sliver was 10%. Keep 10, lend 90. The borrower spends the 90 at a store. The storekeeper deposits the proceeds. That second bank keeps 9 and lends 81. And the process repeats down the line. By the end, your original 100 seems to have multiplied into nearly 1,000 in bank balances scattered through the economy. The catch is that only a tiny base is cash. The rest exists as debts and claims. Here is the twist. In the United States today, that neat reserve multiplier picture is outdated. Since March 2020, reserve requirements for many deposits are effectively zero. Banks are not constrained by a fixed percentage of your deposit being locked in a vault. So, why don't they lend into infinity? Because a different set of breaks took center stage. Capital rules and liquidity rules crafted by international committees in Basel, Switzerland. These Basel standards, updated after the 2008 crisis, require banks to hold enough shareholder equity to absorb losses and enough liquid assets cash and top-tier government bonds to survive stress. The riskier the assets, the more capital the bank must fund them with. Notice how this flips the simple story. Banks do not take deposits first and then lend them out like a shopkeeper selling inventory. In practice, they extend a loan first, and the loan creates a matching deposit. When a mortgage is approved, new numbers appear in your account. That deposit is fresh bank money, conjured, because you signed a promise to repay. Afterward, the bank checks that it still meets the Basel yardsticks for capital and liquidity, and, if needed, it raises funding or sells assets to stay compliant. That is why most money in circulation is not central bank cash or reserves. It is bank-created credit. That architecture produces three constant side effects. First, inflation pressure over time. When credit grows faster than real goods and services, the purchasing power of each unit tends to erode. Prices rise not only because of supply constraints or demand shocks, but because money-like claims proliferate faster than output. Second, perpetual indebtedness. Because new money is born as a loan with interest, the system requires continuous refinancing, fresh borrowing, or occasional defaults simply to keep functioning. Third, concentration of power. Banks earn interest on balances created at the stroke of a key. Governments can finance themselves without immediately raising taxes, and asset owners benefit as inflation drifts asset prices upward while wages chase from behind. When belief shakes, the curtain lifts. In the early 1930s, credit had outrun the metal and income backing it. As fear spread, depositors lined up to redeem. Vaults proved thin. Thousands of banks failed. During the 2008 crisis, credit had multiplied through mortgages and securities layered on those mortgages. When defaults rippled, the web of obligations trembled. Funding markets froze. Central banks and treasuries injected trillions, guaranteed liabilities, cut rates to zero, and bought bonds at scale, all to preserve the system's heartbeat. They didn't rescue a few bad actors. They rescued the mechanism itself. Look abroad, and you see the same rhyme with regional variations. In the euro area, the United Kingdom, Canada, and Australia, reserve ratios are symbolic or non-existent. Capital and liquidity metrics do the heavy lifting. In China, India, and Brazil, high reserve ratios still steered lending, but Basel rules still frame bank risk. In every case, the leash on money creation is not a mountain of deposits in a basement. It is a matrix of risk weights, equity buffers, and stress tests agreed in Basel. Here is the uncomfortable implication. The machine cannot run if everyone becomes debt-free at once. If households paid off every loan tomorrow, bank-created deposits would evaporate alongside the liabilities they mirror. The money supply would contract violently. Spending would plunge, and output would fall. The system leans on your participation, your readiness to borrow, to spend, and to accept digital entries as solid value that will be honored tomorrow. So, what do you do with that knowledge? First, separate money from wealth. Money is a claim, wealth is capacity. Real wealth shows up as productive assets, useful skills, resilient relationships, knowledge, and degrees of independence, things that retain value when paper promises wobble. Second, treat debt with respect. Leverage can speed up your plans, but it also binds your future to a framework that favors creditors and uses inflation to tilt the table. Third, see inflation not as an accident, but as a feature of the design. In many eras, you are asked to run a little faster just to stay in place. This is not a call to panic or to bury cash in jars. It is a call to literacy. Keeping every spare dollar in a checking account will not defend you from dilution. Blind faith that the bank has my money will not make you free. Building durable forms of wealth skills that cannot be confiscated by spreadsheet, assets that serve enduring human needs, savings buffers that buy you time, gives you options when the credit tide turns. History's rhythm makes the pattern easier to recognize. The goldsmiths overissued receipts, the 19th century bank runs, the Great Depression's collapses, the housing bust of 2008, verses of the same song, promises that multiplied beyond underlying reality, sustained by confidence until confidence cracked. Each time the official remedy was similar: shore up trust, add new rules, expand backstops, and restart the cycle. Because the modern economy is conditioned on the wheel continuing to spin. The next crack will rhyme, not repeat. It might appear as a sudden scramble for collateral, as slow-motion losses that squeeze margins, or as a rush into the safest assets. It might begin in real estate, in the shadow banking world, in sovereign debt, or in a corner no one is watching. What will matter again is belief. Do people accept bank deposits as money, and do institutions trust one another long enough for payments to clear? If that belief wavers, policymakers will flood the pipes again to keep trade moving. To sharpen the picture, learn the difference between base money and bank money. Base money is issued by the central bank, physical cash and electronic reserves that commercial banks hold at the central bank. Bank money is what your account shows, deposits that spring into being when banks extend credit. You can convert bank money into base money only to the extent the system holds cash and reserves ready to meet withdrawals. Day to day, the difference is invisible because payments settle inside the banking network. In a panic, the difference becomes painfully real. Consider a simple case to see the plumbing. A bank approves Maya for a $300,000 mortgage. With a few keystrokes, it credits her checking account. The deposit did not come from someone else's jar. It came from the bank's promise. Maya pays the seller, who deposits the funds at another bank. Across the system, total deposits rise by $300,000 the instant the loan is booked. The bank now holds an asset, Maya's mortgage, and a liability, Maya's deposit until she spends it. To stay within the rules, the bank holds capital against the risk of loss and enough liquid assets to handle a burst of withdrawals. The Basel toolkit can sound like alphabet soup, but the ideas are plain. The liquidity coverage ratio asks, if you faced a rough month, do you hold enough high-quality liquid assets, cash, central bank reserves, or top-tier government bonds to make it through a modeled run? The net stable funding ratio asks whether longer loans are backed by stable funding. These guardrails do not make credit creation harmless. They aim to make it less combustible. Still, confidence is the hinge. Imagine rumors swirl about Valley View Bank. A few customers withdraw cash. Screenshots of lines at a branch spread online. More people show up. The bank sells bonds to raise cash, but takes losses because interest rates have risen. Outflows accelerate. Even a solvent bank can fail if it cannot turn assets into cash quickly enough. That is a liquidity crisis, and it feeds on fear. Deposit insurance and emergency lending facilities exist to break that loop to restore belief long enough for markets to reopen and payments to clear. Zoom out, and you see why cycles return. In good times, optimism lowers perceived risk. Banks loosen, borrowers stretch, asset prices rise, and that rise seems to validate the optimism. Leverage piles up quietly. Then something shifts, rates climb, incomes sag, defaults tick up, and the same leverage amplifies the downside. That is not villainy, it is the math of a system where most money is someone's debt, and where the pace of credit governs the pace of growth. So the next time you glance at your account, remember what those digits represent. Most of that balance exists because somebody, somewhere, signed a promise to repay a bank. It is not the same kind of money the mint prints. It is ledger money created with a keystroke and maintained by confidence, regulation, and the steady beat of debt service. The framework was not designed with your personal freedom at its center. It was designed to keep commerce moving and states financed. Understand the trick, and you can act with intention. Keep prudent cash for shocks, but don't worship idle balances. Manage leverage so a storm cannot capsize you. Diversify your assets and your skills. Invest in capacities that no downturn can erase. Ignore the trick and you will keep running faster just to stay level, surprised each year that prices slipped ahead of your paycheck. If this reframed how you see money, subscribe. The past explains the present, and in future episodes we will connect historical mechanics to today's headlines, so you can navigate rather than react. Note, if you made it this far, drop a plus in the comments your badge for finishing the deep dive. And if you haven't already, subscribe for more long-form stories where money, history, and power collide. Curious about earlier empires of capital? Check out our Others video.